Okay, then let's see. Calculating the business value or the business valuation using the P cash flow to the equity. Then, as I told you, as I explained you, P cash flow to the firms mean it is the cash flows available for both equity and debt holders. Then free cash flow to the equity means the cash flows available only for the equity shareholders. Okay, then let's see first how can we calculate the free cash flow to the equity. Then here I have details for my hypothetical. Here is my hypothetical scenario. Then let's see how can we calculate the free cash flow to the equity. Then we can start it from profit after tax. Okay, then we can start it from the profit after tax. Okay, then to calculate the free cash flow to the equity, we can start from the profit after tax. That means the net profit. Simply, we can start from where? Start it from our net profit. Then I hope you can remember when we calculate the free cash flow to the firms, we start from it where? EBIT. But here we don't need to get EBIT. Simply, we can start from our profit after tax. Profit after tax. Then for the profit after tax, we need to do our familiar to adjustment that we did for the free cash flow to the firms. Adjustment to the non-cash charges and reinvestment. That mean, as I explained you, there can be some non-cash expenses, including amortization and depreciation expenses. Then first we need to do adjustment for amortization and depreciation expenses. That means simply these amortization expenses and depreciation expenses we need to add back into our profit after tax. And also we need to do adjustment for our reinvestment. That means capex for the capex investment and the working capital movement, same as I explained under the free cash flow to the firm. These two we need to adjust to our profit after tax, adjustment for the non-cash charges and the reinvestment. And then we need to do special adjustment here. This is the only for the free cash flow to the equity calculation. What is that? We need to adjust net borrowing. Net borrowings. Then what is the meaning of the net borrowing? Net borrowings means we need to adjust debt repaid and debt obtained into our profit after tax. That means if we obtain new loans during the period, we need to add it to our profit after tax. If we paid some borrowings for the debt repaid amount, we need to deduct it from our profit after tax. Then we can get what? Then we can get our free cash flow to the equity. Then here, this is the important adjustment. Okay, this is the important adjustment. When we calculate the free cash flow to the equity, what we need to do? We need to adjust the debt net borrowings. Net borrowings mean debt obtained minus debt prepaid. Then we need to add, actually we need to add this. Okay, we need to add debt obtained minus debt repaid. That means if it is a positive one, we obtain, no, therefore we can add. And if it is a negative one, that means we debt repaid and obtained, therefore we can deduct it from our profit after tax. That simple thing is to derive the free cash flow to the equity, we need to add debt obtained and we need to deduct debt repaid from our profit after tax. That's the thing that we need to special as a special adjustment when we calculate the free cash flow to the equity. Okay, then we need to start it from here. We need to start it from our profit after tax. We can start from our profit after tax. Then we need to add back our non-cash charges, including amortization and depreciation expenses. And then we need to adjust what? Reinvestments, working capital movements and the capex investment. Then addition to the non-cash charges and reinvestment, then what we need to do? We need to adjust net borrowings. Net borrowings, that means we need to add debt obtained and we need to deduct debt prepaid amounts. Then we can derive what? Free cash flow to the equity. Then we can derive the free cash flow to the equity. Then from the free cash flow to the equity for the implicit periods, same way. Okay, we need to calculate what? Our terminal value. It's the same way that we discuss under the free cash flow to the firm. We need to calculate terminal value. Then we can get the total cash flows. Total cash flows. And yeah, there's one thing, special thing that you need to keep in your mind when we calculate the terminal value as well as when we calculate the discount present value of the cash flows. Here we need to use only cost of equity. Okay, for the discounting purpose as well as for the terminal value calculation purpose, we need to use cost of equity. That's important. Then under the free cash flow to the firms, we use WACC because free cash flow to the firms mean it is the cash flows available for both debt and equity holders. No, therefore, for the discounting purpose, we need to consider about the required rate of return, the investor required rate of return from equity holders and the debt holders perspective. Therefore, when we calculate the present value under the free cash flow to the firm, we use the WACC. But here, we calculate the free cash flow to the equity. Free cash flow to the equity means cash flows available only for the equity shareholders. Okay. Therefore, when we calculate the present value, here we need to use what? Only the cost of equity for the discounting purpose. For the discounting purpose, only we must use what? Cost of equity as well as when we calculate the terminal value, then I hope you can remember how can we calculate terminal value. Explicit year-end free cash flow multiplied it by 1 plus G divided by here cost of equity minus what? Cost of equity minus growth rate. Okay. You need to replace WACC by the cost of equity. Then here we can't use the WACC because here we calculate our business value or we try to derive our value based on the free cash flow to the equity. Therefore, here when we calculate the terminal value, we can't use the WACC. We need to what? We need to use the cost of equity as well as when we calculate the present value. Then as a discounting factor, what we need to use? We need to use the cost of equity. Then we can get the present value and summation of this present value we can say as what? Summation of present value we can say as our equity value. Then here summation of the future cash flows, summation of the present value of the future cash flows directly we can say as the equity value because here we got our free cash flow to the equity. No? Therefore, again we don't need to do net debt adjustment and the excess cash adjustment for our here we don't need to do the net debt adjustment. Okay, but if we have some excess cash, then for this equity value, we need to add back this excess cash because again, I need to mention this excess cash, it is not captured from anywhere from here. Okay, then here only capture our net debt adjustment, but excess cash adjustment, it is not captured from anywhere. Therefore, if we have excess cash, then we need to add back into this equity value and then we can get the corrected equity value. Corrected equity value. Then simply we can say the present value of these cash flows. Summation of the present value of these cash flows as our what? Equity value. Okay. Then this is about the free cash flow to the equity calculations, valuation way. But as I told you, this is not more practically we use. Okay. Normally we use free cash flow to the firm. So based on we calculate our value based on the free cash flow to the firm. But we can use this way also. Okay. Then what are the differences? Differences that we identify when we calculate the free cash flow to the equity and based on that equity, when we calculate the equity value based on that, one thing is we need to start it from profit after tax. Then we need to, what are the adjustments that we need to do? Non-cash charges we need to add back. It's a similar as free cash flow to the firm. Then we need to adjust reinvestment, similar as the free cash flow to the firm. Then what is the special adjustment here? We did net borrowings. That means debt obtained minus debt repaid. That means debt obtained value we need to add and debt repaid we need to deduct it from our profit after tax. Then we can get what? Then we can get the free cash flow to the equity. Then summation of the present value of these free cash flows directly we can say as our what? Equity value. And other thing is when we calculate our present value, here we use discount factor based on the cost of equity, not based on the WACC. Okay. Not based on the WACC. As well as when we calculate the terminal value also, we need to use what? Cost of equity. These are the differences that we can identify, compare free cash flow to the equity with the free cash flow to the firms. Okay. Then with that, with this part, I conclude theories relevant for the discounted cash flows method. Okay. Then with that, I conclude all theory part relevant for the discounted cash flow method. Then I am planning to do 2 practice questions, 2 or 3. Then it can be different 2 or 3 practice questions to explain how can we link these theories. Then now we have studied many theories. Not actually these theories also I link it with my hypothetical scenario. Then from these practice questions. Again, I try to link these theories into the questions, and let's discuss the how can we do these questions based on the theories that we discuss. Okay, then let's meet with these two these practice questions.